Good morning, everyone. Happy Tuesday. Welcome to Spark It Up Tuesday on March 9th, very close to the first tax deadline. And that's what we're going to talk about today is tax talk in layman's terms, just to remind all you business owners out there that it's tax time, really, and what to have ready. Because it shouldn't really be a daunting time, especially if you've been in business a while. Doesn't really change what we need to have ready to go. So this is, if you're not already working with a bookkeeping or accounting firm and you're doing this on your own, this is for you. So the first thing is you need to clearly have your books done. So the first deadline is for corporations and partnerships, and that is due March 15th. There is really no reason to go on extension that I can think of. I mean, maybe you have some personal circumstances why it is, but there is certainly no financial benefit. It's actually, it will cost you to go on extension. Extensions are not your friend. I cannot say that enough. Tax extensions are not your friend. So just try and get it filed on time. It'll save you money and get it off your plate. So anyway, we have the corporation and partnership deadline coming up in 6 days. Your books should be done. And what does that mean? That means that you need to have all of your accounts reconciled. That is all of your business checking and savings accounts, any loans, lines of credits, any credit cards. All of those need to be reconciled. And what does reconciled mean? Well, that means that whatever happened on those statements, those checking account statements, those credit card statements, the loan statements, is what is showing and correctly posted in your bookkeeping, whether it is you're using QuickBooks like we do or another accounting software. Every accounting software has the reconciliation feature that I know of. And you want to do that because it keeps everything honest and true. So reconciling is really making sure that the actual formal bank statements that your banks issue mirror what is going on in your book so that everything gets captured. So that's number one. Every single one of your business accounts needs to be reconciled to the penny. Then here are some things to look for. Once all of those are reconciled, that pretty much should shore up your balance sheet. That's the first part that we do, making sure that all of that looks accurate as of the December 31st, 2020 date. If all that looks good and everything kind of matches, right? So the balances on those accounts are matching the actual statements from December, then you're going to move over to P&L and you're going to look for things. So number one is your revenue, that top line, that income. Just make sure that number is truly revenue. So you want to make sure there's no sales tax in that number because sales tax is not income to you. You don't want to report it as income. That's a pass through, only belongs on the balance sheet. So just make sure that your numbers don't include sales tax or tips and gratuity of any kind, because again, that is not income to you. Those are pass through entities and they go onto your balance sheet. So you want a true revenue number because obviously you don't want to claim more income than you actually created in 2020. The other thing that you want to do is make sure, especially when you're reconciling any loans, credit cards, or lines of credit, that you're taking advantage of any interest that you paid throughout 2020. And sometimes it can be as simple as just getting that one year-end extra statement that all of those companies that issue loans and lines of credit, credit cards are required to give you in some way, shape, or form to let you know what amount of interest you paid in 2020. So you want to make sure that interest expense is on your P&L, on your profit loss, because you get to write off the interest expense. You certainly don't get to write off the payments, right? Those payments are a balance sheet item because you're lowering a liability, but the interest is an expense to you and you get to write that off. So you just want to make sure that you have all that interest captured on your P&L. Then once all that's done, and clearly you want to make sure the P&L makes sense to you, you might want to turn to any personal accounts. Now, hopefully you are not commingling your personal and your business together, and whether it's in banking, credit cards, whatever. You just don't want to do that. And that is not coming from any type of ethical or morality standpoint. I don't really even care about that when it comes to this. That just comes to a money standpoint. It will cost you money if you commingle. And that's the first thing. It's more expensive in so many ways to do that. That's why it's bad. But more importantly, if you were to be audited, we know that's, might be a long shot, but if you were and an auditor sees commingling, doesn't go well. It's never something they want to see. When they see that, they immediately think some type of fraud's happening and they're going to dig, dig, dig. You're just not going to make them go away. When and if you get audited and they start looking through your financials and they notice that everything looks like a business expense, chances are they might sit back and be like, okay, this person's legit, and they're not going to look as deep as they might. When they start seeing that personal stuff going through business accounts, it is never a good thing. So that's the second reason why not to do it. The first reason is that it's bad for you personally and it's bad for your business to commingle. So I'll get off that. But if by chance you had to use any type of personal credit card or debit card or whatnot to pay for a business expense, you might want to go through those personal statements and look and see if there was anything that you just pulled the wrong credit card or debit card out for, or any other reason that might have happened, to make sure that you can then post that into your P&L to take advantage of that expense. I know that had happened with me actually every year at some point during the year. I end up paying for something business wise with a personal way, whether it's through my credit card or debit card or check. And it could just be a convenience thing. And I do it at the moment. I have to go back and remind myself, hey, I need to bring that over to my books. And then that is done via a journal entry, which is something that we would do. If you're doing your own books and you're not sure how to do a journal entry, then I would just make sure you take that to your tax accountant, your CPA, and say, hey, by the way, I also paid for this personally. And they'll know how to do that for you. So yeah, so you want to look through and make sure you're capturing any expenses that you paid for personally on your business. One example is we recently started working with a realtor and she was paying for her cell phone personally. Now, for a realtor, they pretty much live on their cell phone for work. That is definitely a business expense, especially if you don't have a separate one. I know a lot of times that you might be going to Target or Walmart on the weekends or shopping on Amazon and you're buying a bunch of things and maybe you grabbed an extra roll of paper towels or toilet paper or whatever it is that you got at home and you brought it to work. Well, guess what? Now it's a business expense. So you want to look for like those type of things to capture those expenses. Now, that's all the banking information and that's your P&L. And those should be good to go to your tax CPA. The second thing you want to do is maybe get a little package together for them so there's not that so much back and forth of questions. You really just want to get your taxes done and off your plate. So the other things that a lot of CPAs look for is if you have payroll in your business, you want to make sure you give them the 4 quarterly 941s. Your payroll company will have those. And also the annual 940 and the annual W-3. And that W-3 is the total of all the W-2s you may have issued for employees. And the 940 is the total of all the 941s. So you want to have those ready to go to your CPA. What you might want to do if you want to get really adventurous is just make sure that the gross wages that are reported on the W-3 and the 940, those annual reports, match what your profit and loss statement is saying are your gross wages. If not, your CPA might just make an adjustment or they might make you go back and do the work. So you want to make sure that your gross wages, because that's a number on your tax return that has to tie to what the payroll company had been telling the IRS all year round and the state that you're in. So you want to make sure that payroll is totally tied out to the penny. So you might want to get those together. And then a lot of CPAs also want to see your December statements. So banking, checking, savings, loans, credit cards, they might want to check your December statements to match to make sure that that's what your balance sheet has as well. So you might want to have those together. That's pretty much the package that you need to send for the average business. Now, all right, that's that. And then, okay, so that's pretty much the whole package. So you have your balance sheet, your profit and loss, your December statements for all your accounts, any payroll, quarterly and annual reports. You get those over to your CPA. That's going to alleviate a lot of back and forth. Now, the last thing I just wanted to touch on before we sign off is the bottom line, right? And that bottom line is your profit. That is what is taxable to you no matter what entity you are. So that bottom line, I guess it's almost like a double-edged sword in some way, right? Some people want to see it high, meaning that they have a profitable business and a healthy business, they're doing well, but that also means that you're going to have to pay your taxes on that. We're Americans, we pay taxes. That's what we do. On the other side of it, you might want to show a loss because you don't have to pay taxes on a loss, but that doesn't look good. Like you're not operating a profitable business. That loss showing came from somewhere, meaning you probably either put a lot of money in your business personally or you have debt. So loss is not good unless you just, your sole purpose in life is to not pay taxes. But that really only goes one way, which is down the drain. So you really want to be profitable. And the thing is, even if you're profitable on that bottom line, and you're going to plan to pay anywhere between 20 and 25% of that bottom line, depending on what your personal circumstances, but overall, 20 to 25%, somewhere in there is what you're going to pay. You should owe nothing as of April 15th when you go to file your personal taxes, because you should have been paying that quarterly throughout the year. That's the whole point of doing quarterly estimated payments, is that you look at your P&L every quarter, you see what looks taxable, and you pay what you should owe on that profit quarterly, so that at this time of year, when your books are done and your taxes get filed and you show a beautiful profit, you've already covered the taxes. So when you go to file personally, you should owe zero. That is always the goal. It's not to get a big return, because that means that you just let the government use your money for basically free all year long. And you don't want to owe a ton of money, because then you're going to dread April 15th every single year. So the goal is always hit zero. I know doing my taxes the last 10, 15 years, I've been up and down, but the last 5 years, especially since I started Profit First, I usually am right around a couple of $100 I get back. That's basically zero, which is great. And that money I just put to my next quarterly payment. So it just goes round and around without me ever having to have that, oh my God, April 15th taxes are due. There's an easy way to set up that system so you can still be happy about being profitable and not unhappy about having to pay taxes. It does all work out. Profit First is a great way to do that, but there are other ways to make sure that happens as well. So that is it. That wraps up our tax talk for today. Thanks so much for watching. Happy tax season.